everyone, Tanis here from Kelly, Grant, and Tanis, bringing you the latest updates regarding laws impacting Florida community associations. Several new laws were passed July 1st, 2025, affecting condos and co-ops. While there were no changes to Chapter 720 HOAs, homeowners and homeowners associations should pay attention to the changes that impact community association managers. Let's break down what's important to you and why. Please keep in mind, this video is for educational purposes only. You should seek the legal advice of a Florida community association attorney before acting on any specific issue affecting your community. Financial reporting, records, and new investment requirements. The requirements extend the deadline for annual financial reporting. After the end of the fiscal year, the association has 180 days to deliver its annual financial report or give them notice to the owners that it is available upon request. This is important because the old law required for a shorter turnaround time, 120 days. And that just isn't reasonable sometimes, especially when an association is dependent upon busy accountants and tax professionals to prepare the reports for them. If the association receives a request for the annual financial report, this must be provided within 5 days at no charge. An affidavit must be executed by an officer or director confirming that the required notice was sent or the report was delivered. Change to annual financial reporting requirements by vote. An association who receives approval by a majority of all voting interests may prepare a cash receipts expenditure or a completed financial statement instead of an audited financial statement. This is important because the law used to require a different level of reporting based upon the association's total annual revenues. The more money an association handles, the more complex and expensive it is to prepare that type of report. This change now allows for condos who obtain a majority of owner vote to save money on preparing the type of financial report each year. Financial reporting for shared facilities. For condominium associations owning common elements used by multiple associations, for example, shared facilities, the new laws require them to submit a comprehensive financial report detailing the costs of maintaining and operating the shared facilities. Substitute budget procedures. If a proposed budget exceeds 115% of the assessments from the prior fiscal year, the board must propose a substitute budget that excludes discretionary expenses. What is not included in the 115% calculation is the following: reserves required by statute, anticipated non-recurring expenses related to the repair or maintenance of components identified in Sears, and insurance premiums. Then the substitute budget must be presented at the annual budget meeting. Unit owners will have the opportunity to consider and vote on the substitute budget. A majority of all owners, unless the bylaws require a higher threshold, must vote in favor of the substitute budget. If the substitute budget does not obtain at least a majority of written approval by the members, then the board may adopt the original proposed budget. Practical tip: Sears and Milestone study identified items are always excluded from this formula. That means those items alone could exceed the prior year's budget and be more expensive than 115% of the prior budget year. Items that can be excluded in the substitute budget, those are usually beautification or discretionary projects. For example, a condo budget that includes costs for front entrance sign remodel when the building's roof needs to be replaced wouldn't be appropriate until the roof is paid for and replaced. That goes for all other Sears items that take priority before any discretionary spending. Investment of funds. Condos are now permitted to invest association funds with traditional banks and certificates of deposit. The board of directors are required to utilize best efforts to make prudent investment decisions when investing the association funds. This is a vote of the board only. not the members. Practical tip: board members should never rely on their personal experience to invest. It is best to always seek the advice of a financial advisor. Inflation adjustment for reserve threshold. A new section of 718 requires the DBPR to annually adjust the $25,000 reserve threshold to account for inflation using the Consumer Price Index. By February 1st, 2026, and each year thereafter, the DBPR is required to prominently post the updated inflation-adjusted threshold on its website. This law ensures that the minimum amount triggering mandatory reserve funding remains aligned with economic conditions. Pooling of reserve funds. Associations may pool reserve accounts for two or more required components. Sears components may only be pooled with other Sears components.